Hi, this is Chris Hewen. The goal of this video is to help you put the excess return model into practice. We have a spreadsheet that downloads data from Capital IQ to allow you to easily implement this model. So let's talk about the basic concepts first. How do you define excess equity return? Well, in the investment valuation textbook by Aswath Damodaran, he defines it as the return on equity minus the cost of equity. These are both expressed as percentages times the amount of equity capital invested by the firm. Another way of looking at it is, how do you take this excess equity return over a period and turn it into a target price for the stock? Well, you can value the stock as the sum of the equity capital currently invested plus the present value of all the expected excess returns that are going to go to equity investors in the future. And one of the questions that you have to answer is, how many periods in the future are they going to have these excess returns? At some point with competition, you would expect that the return on invested capital is going to converge with the weighted average cost of capital. Another way of looking at it is using the notation that's often used in the CFA program. In this notation, the intrinsic value of the stock is equal to the book value plus the sum of the residual incomes, and these are basically the present value of the residual income. So Ri divided by 1 plus R to the power of T is just computing the present value. 1 plus R is equal to 1 plus the cost of equity capital. So the notation is a little different, but the concepts are completely the same. Damodaran may call it the equity capital currently invested, but in the CFA program, it's generally referred to as the beginning book value, B0. Aswath Damodaran may call it the excess equity return. In the CFA program, they call it RI, or residual income. Another way of thinking about RI is it can be the net income, which is labeled E, the earnings for the company, minus the cost of equity, this little r, times the beginning book value. One of the disadvantages of traditional discounted cash flow analysis is that your output is very sensitive to the terminal value, which is a value that is far off in the future. How easily are you able to estimate a value so far in the future? Well, it's really quite challenging. But when you're using this excess return model, you're basically focusing on the beginning book value, this B0, which is in both of these formulas. Again, Aswath Damodaran calls it the equity capital currently invested. So it's much easier to have faith in a number that is in the current time period as opposed to some estimate of value that's far off in the future. So let me sum up this model. What this model is saying is that a company is generating excess equity returns when it's investing capital at the ROE at a higher rate than is expected by investors. And this cost of equity is really a reflection of the risk of the company. This cost of equity really reflects what an investor is giving up, because the cost of equity should be the opportunity cost of capital, which is the return associated with equivalent risk investments. So enough theory, let's talk about actually putting this into practice. I have a spreadsheet, and in this spreadsheet you're going to have to fill in the yellow sections of the spreadsheet. You're going to have to identify the length of the excess return period, that period where the return on investment, the ROE, is basically going to exceed the cost of equity. You're going to have to identify the cost of equity. You're going to have to forecast the return on equity in the future, and you're going to have to forecast the dividend payment. All these things you're going to have to do. You're going to have to look at the company that you're analyzing and figure these four things out. There's several formulas that are used in the model, in the Excel spreadsheet, and these operate behind the scenes. But I want to be very explicit before I show you the spreadsheet about what these formulas do. The net income is going to be equal to the beginning book value of equity times the return on equity. we're going to get the retained earnings, RE, and that's going to be equal to the net income minus the dividends paid. And the ending book value of equity is going to be equal to the beginning book value of equity plus the retained earnings. So these are the formulas that are going to work throughout the spreadsheet. If you're curious as to how the spreadsheet calculates some of these numbers, I want to remind you of a couple of Excel shortcuts. If you press Alt-MP, that's going to trace the precedence. It will draw arrows to show you where the numbers are coming from in the formula. And once you have these arrows drawn, you can remove them by pressing Alt-MAA, and that's going to get rid of the arrows. When you're trying to analyze a complex spreadsheet, these shortcuts prove to be very helpful. So in the next video, we'll talk about the actual spreadsheet.